Okay, so let's go to your sheet here. Okay, we're looking at this. All right, so we were trying to distinguish between these kinds of models which you're all familiar with, based on forecasts, and the arbitrage free valuation models. Okay, which so what we are trying, so the main thing, so let's understand first the key feature of arbitrage free valuation models and their, I mean, this approach to valuation. Both of these are approaches to fair value. Both of these are approaches to finding out the fair value, but they're fundamentally different, because in these approaches the exogenous variables are, at least some of them are forecasts. Okay, so that's why I'm calling it forecast based valuation. But here you will notice in AFV there is no forecast involved, right? What we saw yesterday. Okay, so let's just look at, let's try and put some definitions on that, mainly to understand. Yeah, so I put the notes here in your session outline. Later on I'll create a separate note just topic wise on valuation. Okay, so we have already, so this is there right now in your notes for today, right? So this part you're already familiar with, value versus price based, comparison based analysis, which we discussed yesterday, these frameworks. Okay, so in general what we say is all valuation is subjective and price is objective. Is this clear? Yes. Okay, but there is one type of valuation which is not subjective, which is what you saw yesterday. Okay, I'm trying to figure out the sheet where we had that, which is the sheet where we noted down this, I think, is it below here itself, or so I think I did it in this sheet, uncovered and covered interest rate arbitrage. Okay, uncovered and covered interest arbitrage. Okay, so this is where we wrote it down. Okay, so the example that we discussed yesterday. Okay, so what we were discussing is what is the so the approach to, so when you look at a market price here, you're trying to figure out whether you should buy or sell. Okay, and one of the ways you can do it, if you don't believe in TA, all right, one of the ways actually arbitrage free valuation will apply even if you believe in TA. This is the exception, because as you will see, arbitrage free valuation is 100% objective. So even if you believe in TA, if you see a proper a case of true arbitrage free valuation like what we discussed yesterday, if you are able to see such an opportunity in the market, even if you believe in TA, you should grab it, because this is free money. This is just a surefire thing. There's no market risk. You should just grab it. Okay, so this has nothing to do with the belief in TA. So this is the one exception. So that's why I've said that all valuation is subjective, price is objective, but the only exception is what we call AFV, properly so called, which is written in your this terminology is taken from an English jurist called John Austin, who referred to laws properly so called and improperly so called. So I've just tried to use that, but you can just think of what is true AFV or not true AFV. Okay, so this is AFV, what you saw yesterday, that is not subjective. And why do we say that? Because as you can see here, there's nothing subjective about it, because you can see the prices. Your estimate of the fair value of North Delhi sugar was 45, because you could see for 45 rupees you could create a synthetic equivalent for the natural sugar being traded in the North Delhi market directly, but you could create a synthetic equivalent for 45 rupees by buying it in South Delhi and transporting it to North Delhi. This is clear? Okay, so this is really the heart of arbitrage free valuation. If you want to understand arbitrage free valuation, and first we are trying to understand what true AFV is. Later on we'll see why option models are not true AFV. Okay, and so the heart of this is basically two words: synthetic equivalent. You remember synthetic equivalent? Yes, from options? Yes, okay, so the idea is always when you see something like you see a call option being traded in the marketplace, the call option has a certain price. Yeah, you look at a model like this, you find that a call option has one price. Okay, and then you can think about a synthetic equivalent, which is, now what are you doing in the case of synthetic equivalent? You're essentially saying, okay, can I replicate the payoff of this call option? Can I replicate the payoff by using some combination long short of other instruments, right? Okay, that is the idea behind the synthetic equivalent. Okay, I'm going to replicate the payoff. Okay, but I will not be using the call. I'll be using some other combination of instrument, long, short, underlying asset, call, put, whatever. I mean put, but not calls. Okay, so is this clear? The idea of the synthetic equivalent. Okay, so then what you do is here. So as a call option, what will be the synthetic equivalent of the long call if we do some revision?
Long underlying and short.
Long underlying and short put. Anybody else with a different view? Long put, a long stock, and so he is actually correct. Okay. So you said short put. He is actually saying long put. Long put is the correct answer, not short put, because think of it on either side of the price. Okay. So if you want to replicate the payoff of a long call, okay, you need the as the price market rises above the strike price, you need the payoff to be linearly increasing, okay, proportionately. Okay, so that will come from taking a long underlying position, because there also the market, your profit will position will show profit as soon in proportion to the rise in the market price. Okay, but the problem with the long, you start with the first step, long underlying. But the problem now with the long underlying is on the downside, as the market drops, the long underlying shows a linear loss profile. That you don't want. You want the losses to be cut off, okay, at some point. Okay, so that will come from long put. So what will happen is that the long put will make long put also will make your proportional profits as the market price falls, and that will offset the losses on the underlying on the long underlying. Yeah, you go back to your Hull textbook and see those things. We have already done this in options. Okay, so the idea behind the long put is that it will completely offset, because as the market declines, the long put makes money proportionately, and that money will offset the losses on the long underlying. So together, the long underlying and the long put create the same payoff profile as the long call. And the long underlying, for the long put, you'll have to pay something. Okay, you have to pay up some money because you're buying the option. You have to pay out, you have to shell out some premium. So you will see a part which is below the zero line. That is the cost of your put option. Is this clear? Right? So that's what you're saying. So now what you will say is that whatever it costs me, so you will say now, what is the fair value of this call option? The fair value of this call option is whatever it costs me to create the synthetic equivalent of the call option. Are you following the logic of the synthetic equivalent and how it is used to arrive at fair values? Okay, so once again, this would again be a case of true AFV, because if assuming the underlying and the put option are freely traded, you can see their prices in the markets. Okay, in fact, if you read if you look at go back to your relevant sections of the option notes. Okay, if you see I refer to certain parts of the Nattenberg book. Okay, the Sheldon Nattenberg book on option volatility. He has given some very good examples of how you can make money if the prices are out of line. Okay, so once again, this is an example of true AFV, because you're deciding, you're arriving at so the heart of AFV approaches to valuation is basically this synthetic equivalent. So you always will think of creating, to find out the fair value of something X, you will always think about, okay, can I create a synthetic equivalent of X without using X? Can I create the payoff profile which is the same as X by using some combination of other instruments, long, short, okay, which will have the same payoff profile of X? Then that will become the synthetic equivalent of X. And so the thinking is, whatever it costs you to create the synthetic equivalent, that alone should be the fair value of X. Because if it moves away from there, then there will be an opportunity to make a risk-free profit. Just like you saw in this example, where the North Delhi sugar price has moved away from its AFV, from its fair value determined using AFV, true AFV principles. Okay, you can see that the fair value of the synthetic is actually the cost of generating the synthetic equivalent is only 45 rupees. So the market price is out of line with the fair value, and in this case, because the market price is higher than the fair value, we will buy here. We will buy the synthetic equivalent and we'll sell the higher price one. So we'll make a risk-free profit. Okay, this is clear. So understand the idea behind the arbitrage AFV principles of valuation is it always involves a synthetic equivalent. You always think in along those lines. Okay. So now the other thing that we said is, obviously this is a case of true AFV, therefore it's not subjective. So now you understand in the first place why I have made a distinction and made it a different approach to valuation compared to this, because here your inputs are subjective because they are forecasts. Okay, so different people will come up with different values. That's why when you look at equity analysts being discussed, if you're watching other programs like Bloomberg Technology, gives you very good coverage of technology companies. A lot of analysts come on regularly and they will discuss the valuation of Apple, the valuation of WeWork and this, that. So you'll see, but you'll see that most of the analysts have different views. Some people are bullish, some are bearish. Why is that happening? Here there's no scope for different views. because we know what the price in South Delhi is, we know what the transport cost is. There's no question of subjectivity. These prices are available in the market, so there's no scope for people to have different views. But in this block here you have which is most of the fundamental analysis that goes on in the markets. This is all subjective because it's based on forecasts, and different people have different forecasts. All right, so that's the main reason I've made this distinction. Okay, so this particular type of valuation technique, which involves the thinking along the lines of synthetic equivalence and the cost of generating the synthetic equivalent, that's your fair value using AFV methods. Okay, and why did we said as why is it AFV? Because if you do it this way, if you set this is an AFV fair value, because if the market price is set equal to this AFV fair value, then there is no opportunity to earn arbitrage profits. That is, it is free of arbitrage opportunities. That's why we say arbitrage free valuation. This is clear? All right. Okay. And whenever it's out of line, there's an opportunity to. And so essentially, so the other important concept that we have to understand here is this concept of classical riskless arbitrage. I put all the notes here. I might reorganize a little bit. Okay. But the other important point, which actually should be understood, we can use this example itself as understanding classical riskless arbitrage. I've got the okay. So we have to understand another term. Okay, why have I used this term, classical riskless arbitrage? If you use it generally, because there's a lot of misuse of this word in the industry. Okay, there are lots of instances where people use the word arbitrage to describe transactions which are actually not examples of classical riskless arbitrage. So I've had, basically, people will understand when you use this term, but the reason I deliberately created this term is to distinguish CRA from other cases of the use of the word arbitrage, which are not true arbitrage, which are not really riskless. Okay, so arbitrage basically should be riskless. Okay, which you saw here in this example. This is an example of classical riskless arbitrage, because you have two different you have the same item, the same base asset trading at two different prices. One is of course the synthetic equivalent, okay, because the grade of sugar is the same, and you have the same base asset trading at two different prices. Okay, so by trading with different counterparties, two or more counterparties, you can essentially lock in a riskless profit by simultaneously buying and selling. So you sell the one which is overpriced, okay, and you buy the one which is underpriced. All right. So the idea behind, so this idea of classical riskless arbitrage is also intimately connected to the idea of the synthetic equivalent, because what are you comparing? The price of the synthetic equivalent versus, let's say, we can call it the natural price. Since we are saying synthetic on one side, let's call the other one the natural price. So here, this is the natural price or the direct price, okay, and the synthetic is the indirect or the synthetic price. Okay, so when we are talking about classical riskless arbitrage as being simultaneous buying and selling of the same base asset in with two different counterparties, okay, to lock in a riskless profit. Okay, so there you can see already built into that is the idea of the synthetic equivalent, because what you are always going to compare it to see whether there is any opportunity for CRA. Okay, I'm going to keep on just using the word CRA now for classical riskless arbitrage. This is such a big expression. So to see whether there's any opportunity for CRA, you will always first calculate the cost of the synthetic equivalent. So you will ask yourself, is there a possibility to create a synthetic equivalent here? And can I actually execute the arbitrage? That's also important. As I said, if the North Delhi NDMC puts up barriers and says no movement of sugar from South to North Delhi, then you're stuck. You can see that on paper, yes, we have this theoretical equivalent, but since I can't actually buy in South Delhi and deliver in North Delhi, I can't actually force these two prices to come together. Okay, remember in this paradigm, what is the view? Price versus value based. What is the central view? That eventually price must converge. Sooner or later, price must converge to fair value, right? But the problem here is if the NDMC puts up barriers and does not allow you to move sugar from south to north, there is no way to make the price converge, because you can't execute the arbitrage. Are you following? So that allows the prices to be out of line, and no one can do anything about it. And so understand, maybe I didn't explain the convergence also. So if you think about it, it'll become clear. What happens? So let's say when we see this situation, okay, so people start buying. Obviously, if I see an opportunity like this, why should I trade even in 100 tons? I will trade like 100 million tons because there's free money. Okay, there is no risk, it's free money, so I will trade in as large a size as possible. Okay, maybe 10,000 quintals or something like that. Okay, so what will happen is everybody will try to basically take advantage of this opportunity. So there will be massive volume of buying pressure in this market, in the South Delhi market. Are you following? There will be lots of people bidding for the sugar in South Delhi. Is that clear? I'm not getting a sufficiently emphatic response. That's clear? Okay. Everybody will want to make this money, and how do they make this money? They buy in South Delhi and sell it and deliver it to North Delhi, and they are selling in North Delhi. In the North Delhi market they'll sell, and in the South Delhi market they are buying. This is clear? And they're also bidding, they're also going to be contracting for transport, right? Because they have to move the sugar. So everybody will be doing this in large volumes because there's free money available. So I would like to do it. There's no risk, so I don't have to worry about position size and my risk limit and risk per trade and all that, because there's free money. There's no risk involved. Are you following? Okay, so I want to do it, and so I know I no longer have to do those complicated calculations of what is the maximum amount of sterling that I can buy on this cable trade, because my entry price is this and I can't lose more than maximum of this much on a trade. Here there's no risk of losing money, right? So then I'll do it in as much. So what happens? So there's massive excess demand in the South Delhi market. What is the impact of excess demand on the price? It moves up or down? Price will move up if there's massive excess demand in South Delhi. So this will start moving up. Okay, and here there will be massive excess supply because everybody is coming and selling the same quantity here, because whatever you buy here, so excess supply, the impact on the price is down. Okay, so therefore this will start falling, and 45 will start rising, and this will start falling. So that will lead to convergence of prices. Okay, it will keep on falling. I mean, the the imbalance and the excess demand here and the excess supply here will keep on remaining. Will remain in place as long as the divergence, as there is opportunity to make money, right? When the opportunity is wiped out, then in this case, strictly speaking, the opportunity is only wiped out when the two prices come together. Is this clear? So now you understand what is convergence, that the price, you understand what are the forces that will force the prices to converge. Okay, so this you can see here is a first-hand example of this paradigm working. Okay, remember we are in this block. We are in this block here. So here we always believe that, why do we bother to compute a fair value? Because we believe that the price will eventually have to converge to fair value. Maybe not today, maybe not next week, but eventually it has to come down to fair value. All right. So therefore, that's what we believe, and that's why we do these things. That's why we do this kind of thing, right? That's why we do this kind of thing. So now you can understand how the prices will converge when there is a case of true AFV. This is clear, because this arbitrage will force the prices to converge. Okay, so this is essentially what we call classical riskless arbitrage, and I've defined it here already in your notes, so we can see. Maybe I'll need to add some words here. Act of locking in an instantaneous riskless profit without a capital outlay. This is how we traditionally define it. So you assume that whatever required funds, they are borrowed, and excess funds are lent out. Okay, by simultaneously buying and selling the same asset while trading with this, I should change a little to at least, because all statements have to be correct in all circumstances. You don't have to trade with only two. You can trade with more than two, but you will have to trade with at least two, because one guy is not going to be so stupid that he will buy and sell from him at the same time at two different prices, right? So all right. So is this clear now? Simultaneously selling and buying the same asset. We can put in one more thing here, that often using different instruments. This we have to make clear. Like for instance, what you saw, we could have done an arbitrage if the call price was out of line. If the call price was out of line with the cost of going long the underlying and buying the put. If the call price was underlying, we could have done CRA here also. We could have, if the call price was overpriced, then let's say the call price was maybe the synthetic equivalent of the call was 2.95, and the call is priced at 3.01. In this case, there are many such examples in that Nattenberg book. You can read the relevant segments which are referred to. So in this case, we would sell the call and we would go long the underlying and we would buy the put, and then we would lock in that riskless amount of profit. Okay, so this is basically what we would do, and that's why I'm saying using different instruments. So here I've used 3 instruments actually: call, put, and underlying. Alright, so therefore we need to just modify this a little bit, the definition, by often using different instruments. Okay, so you can understand the same base asset, we can also make this same base asset is being traded, okay, and using different instruments while trading with 2. So everyone understands now the concept of CRA. Another thing to remember about CRA is that when we say riskless, we only talk about, this is why the taxonomy of risk becomes important again. We are only talking about the removal of market risk. It is not free, it is riskless in the sense that it is free of market risk, but it is not free of credit risk. It is not necessarily free of operational risk also, because sometimes if you have both the guys on the phone, one phone line may suddenly instantaneously go down. So there is something that would be an example of operational risk. When you're trying to close a deal and then your internet goes down, or you're trying to transact. That's why on trading floors we usually have redundant internet supply from multiple ISPs. So you don't have the connections dependent on one ISP. Okay, so therefore you have, that is basically to cover operational risk. This would be an example of operational risk. If you're trying to do a deal and then the phone line goes down, that's like operational risk. So that can also happen when you're doing the arbitrage. But generally you go in to do the arbitrage when you see that there is no market risk. Okay, you can clearly remove the market risk. Okay, so all this stuff is in your notes. Okay, so this is there now. Yeah, so while we have now, so you've understood 2 important concepts now. What is arbitrage free valuation? Okay, that it is intimately connected to the idea of the synthetic equivalent, which you've already covered before, and then you've learned a new term which you see here, classical riskless arbitrage, that you should be able to instantaneously remove all market risk, okay, by doing this kind of simultaneous buy sell of the same base asset, creating the same payoff profile, okay, and using different instruments. So that's your classical riskless arbitrage. Now why have we coined this big term CRA? Because there are many terms. Okay, so like one example of a term is merger arbitrage. Okay, sometimes just called merger arb. Okay, so sometimes also called risk arb. Okay, arbitrage sometimes is shortened in the markets to just arb. Okay, so buying stocks of companies that are potential targets and selling, let's put it this way. You understand target and acquirer in M&A? You understand target and acquirer? So another big M&A transaction, which is very fascinating actually, which I was talking about that day, I couldn't remember the term, which is that LVMH is buying Tiffany's. Yes. Okay, that's a very big, so if you're interested in, so one of the things you can, if you're going to be an equity analyst, one of the areas you can, or even a credit analyst, one of the sectors you would focus on is retail. Okay, and within retail there will be a subclass of luxury retail. Okay, so LVMH falls under, both LVMH and Tiffany fall under luxury retail. Okay, LVMH, you know what the full form is? Louis Vuitton and Moet Hennessy, not Hesnay, but Moet Hennessy. So Moet is a champagne and Hennessy is a cognac, and Louis Vuitton, you know, is the luggage and all kinds of other stuff, right? Bags and stuff like that. Okay, so so Louis Vuitton is actually a very, the market cap is quite high. Actually, the head of Louis Vuitton is now the 3rd richest person in the world, after Bill Gates and Bezos. So he's now become the 3rd richest. So there, and the stocks are also rising. And Tiffany's, you know, you had seen this film called Breakfast at Tiffany's. Yes. It's a nice film. Okay, very old classic film. It's got a nice song also in it. You can look it up. The song is called Moon River. It's actually sung by Audrey Hepburn in the film. Okay, so it's a very nice song. So you can look it up. So Tiffany's is basically a luxury. It's like jewelry and all those kind of things. Okay, so so these guys are buying. So now what will happen? What is the merger arb desk going to do? They are going to sell the shares of LVMH. okay, and they will buy the shares of Tiffany's. So you can either do this, so let me just refine the definition a little bit. Buying, selling stocks of companies that are potential targets stroke acquirers. Everybody understands what I mean by writing it this way? Yes? You understand how this is written? Yes? Buying, selling, so you buy the stock of the target. You understand M&A logic? Right? That you have the acquiring company, generally they will have to pay with, sometimes they pay with stock. Okay, I'm not sure what the financing of this transaction is, but sometimes, most of the time there'll be some debt involved. Okay, so they will issue bonds. Sometimes they pay in cash, but to pay that cash they issue bonds. The acquiring company will issue bonds to fund that purchase, and that is actually the connection between M&A and investment banking, because the bond raising the debt capital will become the function of the investment bank. Okay, so and people get confused because the large investment banks have M&A departments also, but that doesn't mean that M&A is investment banking. So is this clear now? Merger arbitrage, you have understood one kind of transaction. You understood one kind of transaction, merger arb. This means basically you buy the stocks of the acquiring company, you sell the stocks of the acquiring company, and you buy the stocks of the target company. Yes? You can do it either before the merger is announced. So when you hear rumors, these guys hear rumors in the market, or they do some analysis and they find out that Tiffany is not doing well, then that LVMH might come in with a bid. There's a high chance. So you can, that's very speculative transaction. Okay, so you can do it then, or you can also do it after the merger is announced. Okay, because before the merger is officially announced is one, or before the merger is officially completed. Because once you announce the merger, there's also time before you complete. There's some uncertainty, because the antitrust regulators may not allow the merger to happen. Okay, so like when Lafarge and Holcim and all these mergers happened in India, they had to go through the Competition Commission of India to get a clearance. Okay, even the Idea Vodafone merger, they had to get clearance from the CCI. All right, so there is, even after you announce the merger, there is some risk that the merger may not happen, because the regulators might shoot it down. Okay, like there's a lot of trouble in the US with the Time Warner, AT&T Time Warner merger. Okay, I don't know if it's still cleared or not. So even after the merger is announced, there's some risk, and there are people who bet on that. So then after the merger is announced, they still, because what will happen is that the target price, the acquisition price, may not be reached. So let's say they're promising to buy, they have offered to buy Tiffany at, let's say, $115 a share. But you might find even after the merger is announced, the market is trading at, say, 95. Because the market is not sure that the merger will be completed. Okay, because the regulators might shoot it down, and that's why it's not trading at the target price. So there'll be guys who speculate even at that stage that I think this is going to go through, so let me buy it at 95 because then I can sell it at 115. Are you following? All this kind of activity is referred to as merger arb or risk arb, okay, in the markets. This is not the right use of the word arbitrage. Okay, so this is not the right use of the word arbitrage. That's why why can you see that? Because there is always market risk. Because you, first of all, if you do it at this stage before the merger is officially announced, then there is very high risk, because the merger may not go through, right? And then the price movement will not be the way you expected. Okay, so the price, you may end up with a big loss. All right, so that's a risk. So there is no, it's not free of market risk. This transaction is not free of market risk, right? So that's why we say that this is not CRA. So this is not the right use of the word arbitrage. So strictly speaking, the word arbitrage should only be used when there is truly a riskless profit to be earned. There is no market risk will remain on the books. Are you following what I'm saying?
Yes.
Okay. So the industry is not particular about the use of the word, so they use it loosely. But you can't force people not to use these words. But you should know in your mind that this is not CRA. Every time you see a misuse of the word arbitrage, you should understand that this is not CRA. Okay, that should be cleared in your mind. You should understand what CRA is, and you should be clear that this is not CRA. Okay, there's another example that I can give you. There are many examples actually. I can't think of anything else. Another thing that you can do is, actually this is also an example of, let me see if I have here, uncovered interest arbitrage. That is also, yeah. So this is also, I'm just giving you another example, okay, which will be, so uncovered interest arbitrage, okay. I'm just giving you some examples. We're not going to explain everything. Also called a carry trade in FX markets. This is called a carry trade. Have you heard this expression, a carry trade? Okay, so this is also an example where I'll just give you a brief idea of carry trades. If you look at, so this is a very famous carry trade that was done a lot for many years, but then eventually people lost a lot of money. Okay, so if you look at, so we'll just briefly understand this transaction also, uncovered interest arbitrage. What you're doing here is, so we're just looking at a couple of examples, then I'll give you one more example of a term which you're just going to be familiar with. Now this is Aussie yen, okay, because for a long time we've had very low interest rates in the yen, and so now recently the Aussie rates have also come down in the last 5-6 years, or maybe more than that. But in the middle there was a time when Aussie interest rates were quite high. Okay, even after the financial crisis, Aussie interest rates were quite high, and yen interest rates were very, very low. They've been low for a long time. So what people were doing is, because they were borrowing in yen, because the interest rate is very low. All right, they were borrowing in yen, and they were selling that yen. So they were borrowing yen, and they were selling that yen and buying Australian dollars. If you see the top part of this here, I've looked at this is uncovered interest rate arbitrage. Okay, where you borrow, in this case, let's say we have taken the example of USD. Okay, so if the USD interest rates are low, okay, then you borrow at 0.5% in US dollars. Okay, so when you get borrowing, you borrow US dollars, you get some dollars in your hand. There's a positive inflow when the loan is disbursed. Okay, so then you take that dollars that you have, those dollars that you have, you sell it in the spot FX market, and you buy Aussie. Okay, so you sell US and buy Aussie in the spot FX markets, and then you see the Aussie interest rates are 2.5%. Yes? Okay, so here you just imagine, for the chart that I'm showing you, that just replace dollars with yen. Okay, in this case we can just write it, because I don't want to make changes everywhere. Just imagine that instead of USD you have yen, so then we can relate it to the chart as well. So then what you have done is you have you have borrowed these US dollars, you have borrowed these yen, you have put it on deposit in Aussie dollars, and you're earning a clean 2% spread. Right, very nice, good time, you're having a good time. But the problem here is that, so this kind of thing, as long as the Aussie is appreciating against the yen, it's fine. But if there is a movement like this, okay, like this is the 2007 credit crisis, okay, when you have a movement like this, there's a sharp depreciation of the Aussie against the yen. Now this downward move is more than 2%, much more than 2%. So basically what's happening is, because you're taking some foreign exchange risk in this case, because what you're doing is you're borrowing in yen, and you're putting it on Aussie dollar deposit. So this is what is called an asset liability mismatch. Your assets are in Australian dollars and your liabilities are in yen. So as long as the Aussie yen rate does not move, you're fine. Or if the Aussie appreciates against the yen, then also you're fine. You're more than fine. But if it goes the other way, then you have a problem, right? Which many Indian companies have also made this mistake, especially when our interest rates were much higher. They borrowed in foreign currencies like Swiss franc, okay, and then they use that money, and they don't have any Swiss franc revenues. They are not earning in Swiss francs, so they have to pay back those Swiss francs with the rupee earnings that they have in India, right? So now if the Swiss franc appreciates against the rupee dramatically, can you see there's a problem? Yes. Okay, because the fixed amount, the Swiss franc liability amount does not change, but now when the rupee depreciates against the Swiss franc, you have to shell out many more rupees to buy that one Swiss franc per unit of Swiss franc, so you suffer a loss. Okay, is this clear? So this is basically another example, although we have used the word arbitrage and the market continues to use the word arbitrage, where this is again not an example of CRA. If we go back to our if we go up to our road, okay, here. So this again is not arbitrage, proper arbitrage. Okay, so we'll give this as the second example. Important distinction CR in other situations. Okay. latter are not CRA. So example, okay, if we write this as example, one is merger arbitrage. You understood why, you understood, now you've learned this, you understood why merger arbitrage is not, first you understood what merger arbitrage is, right? Alright, now you've also understood why merger arb is not CRA, right? So therefore you understand why I'm saying that merger arb is not a proper use of the term arbitrage, okay? Alright, so Garvit still has not learned this lesson. You have. Please come back on time. Okay. So first transaction you learned about is merger arbitrage, also called risk arb. Second transaction you learned about, so we are now just giving examples of transactions where we improperly in the industry, you can't stop people in industry from using these terms. So you have to know what they mean when they say this, but you should also understand every time you see this kind of use of word arbitrage, you should also remember what CRA is, and you should understand that these are not CRA. Okay, so uncovered interest arbitrage in foreign exchange in foreign exchange is called a carry trade. Okay, so this was called a carry trade when people were buying Aussie because when they were borrowing in yen and putting it on Aussie dollar deposit, okay, and earning the higher interest rates in Aussie. Whenever you do this kind of an interest rate play, this is called, in a foreign exchange market, this is called a carry trade. So if you hear this expression, what is a carry trade? This is basically what it means. Carry means you're getting the interest carry. So that differential of 2%, that is referred to as the carry. So you can say I've got a carry of 2%. Okay, but then that carry will not help you much. If there is a massive move in the foreign exchange rate, then you're in big trouble. Okay, so this is what happened to a lot of investors in the foreign exchange markets. When the massive move happened, they ended up with huge losses. Okay, so this again is the proof that because the foreign exchange risk is not covered, so it's not really CRA. You still have some market risk on the transaction when you're doing this uncovered interest, so-called uncovered interest arbitrage. So the use of the word arbitrage here is again not proper. Okay, the third example I'll give you, which you should know, is three examples of this. The third example is what is called volatility arbitrage. Okay, also not proper use of the word arbitrage. Volatility arbitrage, what is this? I've already described this to you. If you remember, when we talked about, I don't know if this thing will open here. Where is our, did we have eyeball? Yeah, I think, was it this one? Yeah, you remember when we discussed this topic, slightly advanced topic in options and vol, we talked about the third meaning of eyeball. I mean the second intuitive meaning of eyeball. Yes. And we said that eyeball is basically the market's forecast of what the H-fall reading is going to be in the future. Okay, if you jump into the future, like this is 30-day eyeball for 30-day options, that's actually the market's forecast of what will happen to what will be the H-fall reading if you jump forward 30 days and then take the 30-day H-fall. Then calculate the 30-day H-fall. Okay, so the market is predicting the H-fall through the eyeball. Yes. So now what option traders do, and I also told you what market makers do in options, okay, which you have not covered that kind of activity. What market makers do is essentially they look at the eyeball. Okay, here of course both are very close together. Okay, but you can see what market makers essentially do is they look at the eyeball that is there in market option prices and they take a view on what will happen to H-fall. Okay, so in this case H-fall is the blue line. Okay, you can see, yeah. So H-fall is the blue line. Suppose this market maker in options, okay, in Microsoft option, takes a view now. What is the eyeball is around 15%. Okay, now this guy may take the view that next 30 days something big is going to happen, and Microsoft H-fall over the next 30 days is actually going to average about 25%. Okay, when you take the H-fall reading after 30 days, it is actually going to be 25%. This market maker can take the view. That's what option market makers do. They take a view on how the H-fall is going to evolve. Okay, and of course eyeball you don't have to, you can take a view on eyeball also, but the current eyeball, because what you're going to compare is the current eyeball level versus your view on how the H-fall is going to pan out in the future. Okay, so the current eyeball level, you don't need to take a view, you can see it in the market. In option prices, you can see the current eyeball level. So he's going to compare the current eyeball level from the market prices of options and against his own view of how the H-fall is going to pan out. Okay, so if he feels that the next, the H-fall for this relevant period is actually going to end up being 25%, and the current option market is predicting it to be only 15%, right, through the eyeballs. So the market is underpricing the risk, right? So he will take a view that the market is under. So what he'll do is he'll buy the options. He will buy options, both calls and puts. Okay, so he'll do transactions like straddles and strangles, which is basically you buy both calls and puts. So he will go long. He will basically go. What he's going to do is he's going to go long the options, okay, and then he will hedge himself dynamically in the market, okay, using the delta of the options and all that. I don't want to go into the detail of that, but the point is here, this is what is referred to as volatility arbitrage. When you hear this term, this is what it refers to, that market makers in options will take a view on future H-fall, okay, compare it to current eyeball, okay. So we'll just write it here, that option MM, okay, option MMs take a view on future evolution of H-fall. Okay, you have understood that. The second intuitive meaning of eyeball, which is already there in your notes, because the eyeball is a forecast of how the H-fall will pan out. So the market maker is actually saying, well, I've got my own view of how the H-fall is going to pan out. Okay, so he's saying that, okay, there are two things here. Now you see once again the same thing. We are both talking about how the future H-fall is going to pan out. Okay, one view on that comes from the eyeballs of the current market prices, because the current eyeball is a forecast of how the future H-fall will pan out. Okay, so the current option market eyeballs are speaking about that topic, but another person is speaking about that topic, and that is the market maker. He's got his own view, and his view doesn't match the market's view. The market is saying it'll be 15%, but he thinks it'll be 25%. So in this case, according to him, the market price, option market, is underpricing the risk of vols. In this case, what he will do, so it's basically like, once again, you can see the same framework. According to him, the fair value of the eyeball should have been 25%, but the actual market price is 15%. So what is he going to do? Buy or sell? He's going to buy the market. He'll buy the options, and then, of course, in order to maintain something near to a riskless portfolio, but it's actually not riskless. But what he'll have to do is, basically, we have not discussed this in detail, but essentially what he will have to do is he'll have to look at the delta of the option, and he will have to keep himself. He will continuously look at the delta and balance his position in the underlying. Okay, and he will manage the option risk. He will manage the risk of all these risks, all these different dynamics of the aspects of the option portfolio risk. Okay, which we're not going into the details of that. But the main point here is that. But once again, he is not guaranteed to make a profit, because this thing is, after all, is just a view. Okay, his profit is not locked in until the end of the 30-day period. If these are 30-day options, whatever his view is, even if he is right, his profits will not be fully realized until he has actually completed that period. So he has to hold the options, and he has to continuously rebalance his underlying position hedges. Sometimes he may have to buy options as well. Okay, but mainly vol arbitrage relates to the move in the underlying, which will create the H-fall reading. Okay, so this is again, so you get a flavor of what he's trying to do, right? He's taking a view on how the H-fall will evolve, and he's comparing it to the market option prices, which is also a statement about how the H-fall will evolve. And there's a divergence between the two, so that he's trying to do this arbitrage, which we incorrectly call an arbitrage. Once again, it's incorrect to use arbitrage here, because it is not free of market risk. Because remember, this is just a forecast. Anytime you have a forecast, anytime any of your calculations in computing the fair value and the market price, anytime there's a forecast involved, because this fair value is, according to him, the fair value of the eyeball should have been 25%, because that's what he thinks it will be. But that's just his thought. So it is no different from somebody coming up with a It's no different from in this kind of a situation when you have a very high NPV for a project, because your view is that the returns from the project will be very high. That's just a view. There's no guarantee that that is going to happen. Okay, so therefore it is not free of market risk. Okay, so that's why this activity which I've just described, you have some flavor of it. You understand something broadly. You may not understand the hedging of dynamic delta hedging and all that, but the point is that he will continuously hedge himself against a long option position by adjusting his underlying position hedges for this kind of what is called vol arbitrage. So this, again, another use of the term very commonly used in the industry. This refers to this kind of activity. Once again, improper use of the word arbitrage, because it is not CRA, because it is not free of market risk, because you will be, whether or not you will make money. Okay, the real problem here is market risk is not removed, because whether or not you'll make money or lose money, that you may end up losing money. That will only become apparent at the end of the 30-day period. If you're dealing with a 30-day option, okay, that becomes the whole thing. The results become apparent only at the end of the option expiration. Are you following? That's why it's not free of market risk. Okay, when you saw classical riskless arbitrage in operation, did you have to wait for any end of period? Here you don't have to wait. Instantaneously everything is locked in. There is no uncertainty. Are you following? Here we don't have to wait for the end of 15 days or something like that to see. The market risk is locked in right now. Okay, and the profit is. So this is what is classical riskless arbitrage, and these are some, we've discussed 3 transactions. You've got some flavor of the transactions also. So that is also some contextual knowledge. But you should understand, everyone understood? You guys here, you're looking kind of like there's a dark cloud or something over here. Yeah, so these are 3 transactions which are quite common, so you should know about the transactions also. And these are all examples of improper use of the word arbitrage, because it is being used to describe situations which are not CRA. That is, market risk is not removed instantaneously to zero and profits are not locked in. Okay, is this clear to everyone?
Yes.
Okay, here also profits are not locked in, because you will never know whether you actually you may end up losing money. Okay, because if the actual H fall keeps on dropping and your view of 25% is just sitting there, you'll end up losing money. Okay, so therefore these are all examples of improper use of the word arbitrage. So we have learned some important terms. We have understood the fundamental approach in AFV. True AFV is always think of synthetic equivalent. Okay, and then it involves obviously classical riskless arbitrage. You have understood the important aspect of that. It is riskless, no remaining market risk. Okay, and then you understood 3 transactions which are this class is 12:45. Okay, so then you have understood 3 transactions which are which are improper, which are examples of improper uses of the word arbitrage. Okay, so this much we have covered. Okay, now let's understand something else. So why did we come to this? We came to this because, now again you might be wondering why we were doing futures, why we got into this, because we had gone into futures, then we encountered this topic called convergence of futures and spot. Remember this topic? Yeah, convergence of the futures price to the let's try and get this. Alright, so we were looking at this topic. So why did I get into the entire discussion about arbitrage? Okay, and then we had to get into arbitrage, and since we got into that, I thought I would explain what AFV is as well. Okay, and why I have made this distinction here. Now you understand why I have made the distinction, that AFV approaches are fundamentally different from the forecast based valuation approaches, because when you're in this box, you don't think about, do you think about synthetic equivalence? You don't think about synthetic equivalence. So that is a fundamental difference. And of course, when you have true AFV, this is subjective still, but when you have true AFV, it's not subjective, it's completely objective, because you can, as long as you can actually execute the arbitrage and lock in the profit. In this case, this is guaranteed to make the price converge to the fair value. As you saw in this example, with no restrictions on the movement of sugar, it is guaranteed that the prices will have to converge. Okay, so this is what is sometimes called, I can write it here itself, that this is, sometimes you might hear this in economics also, it's called the law of one price. that the same asset cannot have two different prices. Okay, so this is obviously, but this is not sufficiently illustrative. It has to be dilated upon with all the discussions that we have had, that you have to be able to execute the arbitrage. If you can't execute the arbitrage, then of course the prices will remain out of line. Okay, so the law of one price only works when you are able to execute class CRA. Okay, so there should be a synthetic equivalent and you should be able to execute the arbitrage. Only then will the law of one price work and the prices be forced to converge. Yes? Okay. Alright. So the other important point I have to explain is why have I put this here. So now you understand why these are different approaches. But now one more thing I have to explain is why have I said that all option valuation models are under AFV but they are improperly so called. Okay, that is, it's a very fancy English expression taken from John Austin, but basically this is not proper AFV and this is true AFV, what you just saw in the case of the sugar arbitrage trade. Okay, so let me explain why the option markets are, why option valuation models are not example of, what is this now, we have to cut marks for Bharat and Ganotra. So we have to now, we have to become more strict. Where is this? Today's session outline. Okay, all right. So let's go back to this. Okay, so everything here has been. So one more thing I wanted to explain is why option models. Okay, this we can do later. Okay, so the other important points is why are. I will just copy it from here. This is the point I'm trying to explain now. Why are all option valuation models so of AFV improperly so called? I'm just trying to. Okay, so why is that? Anybody has any idea? You should now be able to, since you have learned so many things by now, you should be able to already give me an answer. So AFV improperly so called, or let's just say improper AFV. Okay, why is it improper AFV in the case of option valuation models? Now that you know what proper AFV is, proper AFV, you see an example here. Okay, and all these are, maybe hopefully later on we'll find, give you an example, FX cross rates. Okay, so you've seen some examples here, that the simplest example that we showed you, this is true AFV. Okay, because everything is subjective. So now tell me why is an option valuation model, first what happened here, bar chart is blocked. Oh, so when I load it, even though I loaded it in my office, but when I come down here it's blocked. Okay, alright, so why is it now, okay, now this is the reason, let me just explain the first part. Why is it in AFV and why is it improper? Okay, why is it in AFV? So I put it here, all option valuation models I have put under this, I have not put them with this. Okay, all option valuation models are put under AFV because all the option valuation, no matter what model you look at, they will all use the technique of synthetic equivalence. Okay, so the way these option models are all constructed, okay, Black-Scholes, whatever you want to look at, Garman-Kohlhagen, all of them assume that they are going to come up with a synthetic equivalent of the option. Okay, which is what this guy also does when you're doing vol arbitrage. You're essentially trying to create a synthetic equivalent of the option, continuously rebalancing the delta equivalent of the hedge. Okay, so but anyway, so these guys assume, so the reason I put it in AFV is because all option models will use this AFV valuation technique, which means they will look at they will say, what is the fair price of a call option? Okay, they'll say, well, the fair price of a call option is whatever it costs to create the synthetic equivalent. Okay, and then they will proceed to use that technique to value the option, okay, to come up with a fair value. So that is why I have put option valuation models under AFV, because they are using the AFV technique. of using synthetic equivalents. Okay, is this clear? Okay, first part is clear why I put it here. Now second part, can you tell me why, by looking at the model, but based on the discussions we have had, why have I said it's not proper AFV? Yes? Yeah, give her the mic. We can, let's use the mic since we have it. Yeah.
Because the wall input is subjective.
Very good, excellent. So this is the right answer here. Wall input is subjective. Okay, so we can't have in any AFV, in any case of true AFV. Okay, in any case of true AFV, we cannot have any input in the model which is subjective. Okay, if you go back to your example here, what is this? 1 minute. Where are we? Okay. All right, guys. Here, in the case of true AFV, we cannot have any model input to the fair value which is subjective. Everything has to be objective, clearly observable in the marketplace. Is this clear? Okay. But we have this problem that we have in this option pricing model, we have a wall input which is subjective. Here, what we do is the option. What are the option pricing models doing? They make, I just think, I don't know if you're aware of this, but they assume that what volatility will happen in the future, okay, is known. So can you think about how ridiculous this is? It is like saying, for me, it's like me saying that, okay, it is like me saying that I know that I will live till the age of 95. Okay, so first of all, nobody will believe anyone who says that, and the bigger problem is you have no basis for making that kind of statement. Are you following? There is no basis for saying that this person will live till the age, any particular person. Okay, in insurance, life insurance underwriting, you can say that 75% of the population will live till the age of 80 or something like that. Those are numbers. We are making a forecast for large groups of people, but for any given individual, you can't say that this person will live till 95 or 85 or whatever, right? There's no basis for making that statement. So this is the problem. This is why most of these models are quite ridiculous. But all option models assume that the vol is known. And what is this vol? This is a statement about what will happen in the future. What kind of H vol reading is going to prevail if this is a 30-day option. Okay, this input, what the model is asking for here, when it's asking you for this input, is asking you to put in what H vol reading will prevail after 30 days. Okay, so how will the asset price move? Remember, the H vol reading is a function of how the asset price moves. You saw the calculation, right? So this is basically a statement about how the H vol reading will be, what the H vol reading will be after 30 days. Okay, and who knows that? Nobody knows that, right? It's not even possible to know that. Okay, so this is the problem with these options, but all the option valuation models assume that the future volatility is known. Okay, this is why, in my opinion, these are mostly useless, and you'll see that they are not very useful in solving any decision problem, any important decision problem. Whether to buy or sell, you still have to take a view. Underlying asset, eyeballs, you have to take a view, which means you're taking a risk. Okay, so none of these. So this is an example. So the reason I put it under AFV is because they use AFV techniques. Okay, they use AFV techniques because they work with a synthetic equivalent. Okay, and the reason they are able to come up with a price, the reason they are able to come up with this price by using a synthetic equivalent concept, okay, they can say that this price should be 3.01, and according to them, this is an AFV price. Okay, this is an AFV. This price is equal to the AFV fair value, but it is critically dependent on the assumption that the future vol is known. Okay, so this you have to understand about all option models. They assume that the future vol is known. Okay, and that's how they come up with this. So now you understand why I have put it here and why I have said improper. Now you understand why have we put in, maybe Gulati gets up and stop, then he'll wake up because he's sleeping anyway. So if he gets up, then maybe he'll wake up. Okay. All right. Is this clear to everybody now? Why have I put, now you have understood, you have seen that option valuation model in your study of models. Option valuation models are one type of model, and where do we put them? We don't put it under forecast based valuation, but although you can see there's a forecast involved, but I have chosen to put it under AFV because they are using AFV techniques. They are using synthetic equivalent principles. So the valuation principle is AFV based AFV type of approach to valuation. So that's why I put it here, but it's improper AFV, improper to call it AFV because it is not 100% locked down valuation. It is there are subjective elements in the inputs, so the output that you get is not this thing is not an arbitrage free value. This call option fair value is not an arbitrage free value, because remember what arbitrage free valuation is. If this were actually arbitrage free, it would mean that if the call option price, market price is set equal to this, there would be no opportunities for arbitrage. Okay, now may not be opportunity for arbitrage, but there actually, the point is that therefore the price must always converge to this. You understand? If we say because arbitrage free valuation, if you say that something is an arbitrage free value, this fair value is an arbitrage free fair value, okay, that means that if the market price is equal to this fair value, there is no opportunity for making a riskless profit. Okay, but here you can't say that, and therefore the market price has to converge to this. That is a stronger statement that you're making. Are you following? Yes, in any such situation where you can do the arbitrage, the market price must come to the fair value very quickly, because people will otherwise be earning risk-free profits. So the market price has to come to the fair value. Okay, but in option markets that does not happen. Are you following? Yes, sir. Okay, and as you saw yourself, what happens in option markets, it's actually a cop-out. Okay, if you see what the option market is doing, the option market is actually, let me explain this full thing here to understand that the option market is actually a cop-out, because why do we have the concept of eyeball? You see how ridiculous these models are. Okay, so first we assume that we know the future ball, and then we can say, well, if we know the future ball, it's like by saying that, okay, can you predict when Mr. X will die? I will say that, okay, I will assume that I know when he gets a severe case of terminal cancer, and then I'll be able to predict when he's going to die. Okay, because then maybe you can just predict within 1 year the person will be gone. Okay, so this is like assuming that I know the future ball, so then I can predict the fair value of the option. So it's quite ridiculous. And now you see what actually happens in the real world. What happens in the real world is, let's say somebody is doing a fair value, let's say Piyush is doing a fair value of this option, and according to him, the future value of the future H ball is going to turn out to be 25%. Okay, but he looks at, and so therefore he comes out with a fair value of 3.019. But he looks into the market and he sees that, oh, actually this option price is trading at 7.3. So, and there is no way for anybody to necessarily make the 7.3 converge to 3.02. Are you following? Because if you want to do that, you can't do it in a riskless fashion. You will have to take some risk. Okay, if you want to sell those options and push down the eyeball, okay, but you will have to take some risk. So this is not a CRA arbitrage, true arbitrage free valuation. This is clear. So the market price frequently diverges. So what do we actually end up doing in real life? When you look at option trading software, what are they giving you? You mouse over and they're giving you the eyeball. So they're actually telling you that, okay, this one has an eyeball. So you actually are once again looking at the market and putting it into the model. So the model is actually not useful. Okay, so the only types of real arbitrage free valuation models which are useful are what I have shown you here. We haven't discussed any of them. FX forwards, okay, FX cross rates. There are many other examples. Put call parity is another example where I can put this down. We haven't had time to discuss put call parity, but this is an example of true AFV. Because if it deviates, remember, true AFV is only in cases where if the market price deviates from the fair value. If the market price deviates from the fair value, people will be able to earn instantaneous risk-free profits by doing CRA, and very soon the market price will have to converge to the fair value. Okay, no such thing is happening in the case of options. In fact, what we are doing is we are surrendering to the market. You see, this is a sort of surrender to the market. What are we doing? We are taking the market price and we are asking ourselves, what should the vol input be to produce this market price? Yes, to get the eyeball. What should be the vol input be to produce this market price? So we are actually surrendering to the market price and taking the data from the market and then putting it in the model and talking about the eyeball, and still people are essentially, you have to take a view on the eyeball, right? So you now have an understanding of option models from a theoretical perspective. Has everyone understood? Okay, some important concepts we have covered. Okay, so let's go back to this. What else do we have to do? I think most of this covered. Why are all option valuation models examples of AFV improperly so called? Okay, now you've understood this. Okay. All right, maybe I'll put in some extra writing later on in this, but you should have understood the concept here, okay? Because basically you can't make the prices converge. You can't make the price converge to the model fair value. This we can basically know way to ensure through CRA that market price will converge to fair value. Okay, fair value determined using AFV principles. Okay, so this is how we can use the language. So we say we are using AFV principles, which is basically automatically means thinking about synthetic equivalence, and the cost of generating the synthetic equivalent is the fair value. Okay, to fair value using AFC. Is this clear now? Okay, now we are done with all this stuff. Okay, I've just given you some quotes on models, etc. You can read all this. Okay, so you'll see that people who are actually practitioners, even if you listen to this guy, what's his double line capital? I forget the guy's name. Jeffrey Gunlack. If you listen to him also, he's quite skilled in mathematics, but he also doesn't have that much faith in models. So if you look at practitioners, you'll see that you look at Bob Buffett. I'll give you some other links also. These are all YouTube videos. You'll see that people like Buffett are quite skeptical about the value of models. Okay, they use them in the sense they use it as a framework, but they see that there is not much. You can't really rely on it much. Okay, that it gives you a false sense of. So this quote from Howard Marks is actually brilliant. This Howard Marks, I've told you guys to read the memos. Okay, I've given you the link also. All you guys, Mr. Credit Analyst, where's he gone? He's gone out. Everybody's out. Credit Analyst, Chuk. Okay, somebody else is also out. Anyway, doesn't matter. Okay, so very important because Howard Marks is a credit investor, so you can learn a lot by reading his memos. Okay, for you guys, you're just coming into the market, you can learn a lot by reading his memos. There are lots of Howard Marks videos also on the internet. Okay, on YouTube you can see them, so you can listen to his lectures. So this quote I find brilliant actually. It's a brilliant insight into human nature, and he says, can you understand what this means? That part of the reason why people like to hang their hat on models is because most people would rather be precisely wrong than approximately right. So the model is very precise. Okay, so people would rather be precisely wrong than approximately right. So this is not my statement. So you'll notice that the kind of flavor I've given you is shared by many practitioners. Okay, if you listen to Buffett and Howard Marks, Jeffrey Gunlack, many of these people, you'll find the same kind of views on the use of models and things like that. So you should know theoretically how they're constructed. Okay, and so Buffett also, many of these discussions in the annual general meetings of Berkshire, you can see them on YouTube. You can see the questions being asked, etc. Okay, so with this covers us for this topic. Now we go back to our futures. Now we have to cover this point where we got stuck, where we got distracted into this entire discussion about AFV and CRA and all that. Why did we have to go there? Because we had, where is Khushbu? She's fallen asleep. She's not well. So if you're not well, you go home. If you're not well, you should go home. You're not looking well also. So what do you want to do? You have a class. Okay. So that's your call then. As far as I'm concerned, you can go home. Okay? Because we got into the detailed discussion because you said you were not able to follow the first statement about the convergence of futures to spot. Okay? So that's why we went to the long discussion. Yeah? Okay? Yeah, no, that's okay. You don't have to strain yourself. You can relax. You can go home. Whatever you want to do. Okay? But the point is that why did we go into the discussion about AFV and CRA and all that? Because to understand this convergence, we had to understand those concepts. Okay, it helps us to understand this convergence better once we have understood CRA and we have understood AFV and all those things. And since I went into that, I wanted to give the explanation about the taxonomy that I've given you guys. Okay, all right. So now that you're armed with the knowledge of CRA and all that, now can you understand this? Read this a little bit. Can you read this and understand? First, we suppose that the futures is above the spot. Okay? And see what he has written. See if you can understand what is being said here. Look here, Adarsh. Don't look at Ritesh's book. Look here. Try to understand, armed with your knowledge of CRA, because here you have to remember the concept again of the synthetic equivalent. So, if you take one, the futures price can be taken as a synthetic equivalent of the spot, of the physical commodity. Or you can take the physical commodity as the synthetic equivalent of the futures price, because they are the price of the same thing, because you can deliver that physical commodity against the futures contract. So therefore you can see clearly that they are synthetic equivalents, that instead of physically buying this commodity in the market, I can buy the futures contract and wait till I get delivery, not square my position and wait till I get delivered. So that will end up with the same outcome, that the physical commodity will end up in my lap. Yes? Right? So they are synthetic equivalents. Can you see that? Are you able to see that concept, that they are basically the same thing? Okay? Yes? Not very convincing? So therefore, yes, clear, convinced? Okay. So that's why, so what do? Then they have a clear arbitrage, because you have, if you have a synthetic equivalent and you have another asset and it's synthetic equivalent, okay, if the two of them are not at the same price, then there's an opportunity for CRA. Okay, that's what they're saying here. Okay, so then in this case, if you see that the futures is above the spot during the close to the delivery period, okay, then in that case they are basically the same thing, which one commodity having two different prices, okay, one asset having two different prices. So in this case, because you can perform the arbitrage, so the law of one price has to prevail. So therefore you will sell, you will again go back to your same framework, the fair value versus market price comparison. So you see that the market price of the futures contract is some price, let's say 100, but you see that the price of the synthetic equivalent is 85. So in this case, then the futures contract is overpriced relative to its fair value, because it should be trading at 85, not at 100. So in this case, you will sell the market price, okay, which is overpriced, and then you will buy the synthetic equivalent, so that you don't have a net position. Because if you sell something and you buy its synthetic equivalent, then you don't have a net position, because you're actually square, because you have bought the synthetic equivalent and you have sold the asset. Similarly, or you may have sold the asset and bought the synthetic equivalent. Either way, you don't have a net position, because the two are the same, right? So that's what you're doing here. Is this clear? The first step? Yes, Rishti, you're not looking convinced. Is this clear? The first step is clear? Okay. So now you understand. So this will make, because these are synthetic equivalents in a situation where you can actually make the CRA happen. Okay, so therefore this will force. Now you understand why there has to be convergence. Because if there is a situation where you can actually make the arbitrage happen, right? You can make the arbitrage happen, and you have actually, therefore you can make the CRA happen, and you have a particular asset and its synthetic equivalent trading at two different prices. That cannot be sustained. The prices will have to converge. Is that clear to everyone?
Yes, sir.
Yeah? So now you understand why this convergence has to happen, using the concept of the synthetic equivalent and the concept of CRA and the forced convergence. The CRA will force the prices to converge, because the law of one price must prevail given the circumstances. The fact that you can actually execute the arbitrage. Is this clear? Okay. So the first part is clear. The second part is the other part, which you can read it on your own, but now it's the same logic should be obvious. In case the futures is below the spot, okay, once again you will see that the fair value of the market price is below the fair value. Okay, so in this case you will buy the market. Okay, again the CRA will force the two prices to converge. In any case, you can basically lock in the profit by just waiting to get your waiting to get delivered. Is this clear? Okay, any asset and its synthetic equivalent trading at two different prices. okay, will offer an opportunity for CRA unless there's any kind of block on executing the arbitrage. You also have to see the situation on the ground. Okay, as we said, if the NDMC has put up barriers preventing the movement of sugar from South to North Delhi, then the prices will not necessarily converge, because there's nothing to force the prices to come together, because people are not able to execute the arbitrage. You can't buy in Delhi because you can't buy in South Delhi because you have to move the sugar to North Delhi to make delivery. Are you following? Right? So any time in any situation where you see, although theoretically there is a synthetic equivalent, but you can't execute the CRA for whatever reason, maybe capital controls, okay, this and that, okay. So like Indian gold prices, local gold prices in rupees, and world gold prices, theoretically there's a synthetic equivalent, okay, but when you compute the fair value, you'll find that the fair value is about 15%, 10-15% below the local Indian market price, okay. But that's because of import duties and all this kinds of stuff, and there's no free movement of capital, so you can't actually make the prices converge, because you can't freely buy and sell gold and move capital in and out of India. Okay, so that's an example where theoretically you have the synthetic equivalent. Yes, you can see it. You have the dollar rupee price, you have the international gold price in dollars. Okay, you can convert troy ounces to grams. You can see the local Indian price, but you can't execute the arbitrage, so there is no force that is forcing the prices to converge. That's why the Indian gold prices can remain out of line with the world gold prices, because the CRA is not allowed to be executed, so they're not forcing the prices to converge. Is this clear? Okay. Yes? So that covers this topic. Okay, so now we go into the operation of margin accounts. Okay, you can read this on your own, but you have to understand we have already discussed this. Daily settlements. Okay, so in every futures contract there will be something called initial margin. You can read these. I'm not going to write any notes here at this stage. You can see what initial margin is. You guys understand what initial margin is? You can see it here in the book. I think we have a little bit in your notes about where are your futures notes. I actually may not have opened your futures notes. So these are futures on Finviz. Okay, 1 minute. Let me just go into we'll see if I have. So does everybody understand what initial margin is? Yes, Sukriti? What is initial margin? You don't know. Why are you sitting quietly then? What have we discussed? That we have to put up some money in order to trade on an exchange. Now we're talking about ETM. Okay, so to trade with the ETM, to trade on an ETM, you have to put up some money. So that's your initial margin. Okay, so go back and read all the stuff. Okay, let's let's make full use of the time with Garvit's permission. Okay. Japanese management. Surbi has failed Japanese management. Okay. Okay, where are the talk about margins? Okay, you can see here there's a CME group link. What else do I have for you guys on margins? Nothing much. So the rest of the margins material basically comes from the book. Okay, you read these chapters here. Okay, but the only thing I've given you here is the CME performance bonds. Okay, look at this. What do they say here? So there are two types of margins. Okay, as you will see here, there's initial margin and then there's maintenance margin. Okay, so you start with initial margin is what you have to put up to put on the trade. If you don't put up initial margin, you can't do the trade. You can't do any trade on an ATM without putting up initial margin. And remember that chain that we showed you from TIC to IB to clearing member to the exchange clearing house. Remember that chain? So the margin will move all the way up down the chain. And when you get paid for your daily profits, the daily profit will come back up the chain all the way to the TIC. Yes, remember that? Okay. So that's how the margin flows are happening. So you have to put up initial margin, otherwise they won't let you do the trade. So the initial margin, and every day you have, if you lose money, so the market will compute here. Have they given some example? Yeah, they've given an example here. You can look at this. Okay. Alright, so let's say the margin is $6,000 per contract. Okay, so you buy two contracts, you have to put up $12,000. Okay, and say you have bought, let's say I think he's assuming here that you bought it at $12.50 per ounce. Okay, and then the price has dropped to $12.41. Okay, so the trader has a loss of this much. Okay, Each contract is anyone able to follow the calculation here? Each contract is for 100 ounces. The COMEX gold contract, which is part of the CME group now, okay, the gold contract, everything has a contract size associated. It could have been 1000 ounces. They have chosen to make it 100 ounces. Could have been 50 ounces. They have made it 100 ounces. That's just a choice. Okay. The contract size is 100 ounces. Remember, on exchange trade ETM, everything will have a contract size. The oil contract is 1000 barrels. You can't say I want to go and deal in 695 barrels. Not allowed. Okay. 1000 barrel lots, round multiples of 1000 barrels. So here the gold contract is 100 ounces. So you buy 2 contracts, that means you bought 200 ounces. The price is per ounce. Actually, it's troy ounce. They should have written troy ounce because ounce has a different meaning. Okay, ounce is different from troy ounce. So they should have written troy ounce. Yeah, that ounce in baking is not the same as troy ounce. The international gold price trades in troy ounces. Okay, you can look it up on Google. What is the conversion? Okay. But the point is, this is a price per unit. Okay, the unit is 1 troy ounce. Price per unit. So you bought 200 units and you have lost from 12.50 to 41. You lost $9 per unit. Is everyone following? Yes. You lost $9 per unit. Yes. So you lost $1,800. Yes. 200 units. So that $1,800 by next morning you have to pay in. We have already discussed this. Yes, okay. You have to pay it up in the by next morning. Okay. If you don't pay up, what the exchange will do? We already discussed all this. The ECH will close out your position, yes. And whatever loss is incurred in closing your position, they will forfeit your initial margin deposit. Okay, and use it to fund that loss. So the exchange is not really in trouble. Okay. So here you find out. Where have I given the this thing here? Here, what does it say here on the CME? So any exchange that you trade at, actually the initial margin requirements, one is that the exchange will set initial margin requirements and maintenance margin. Okay, maintenance is what you have to maintain. So suppose you put up $6,000 initially for each contract in gold. Maybe the maintenance margin is, just to give an example, maybe it's $5,000. So the moment you experience $1,000 of losses, okay, you will have to top up because the maintenance margin is set at 5,000. You can read this in the notes. Okay, it's well explained in the textbook. Okay, how it works. But there's a second concept called maintenance margin also written in the textbook. Okay, so here what will happen is the initial margin and the moment you hit the maintenance margin because you're losing money, the exchange will ask you to top up. Go back to IM levels. You have to send the money again to top up to IM levels. Okay, this is clear? All right. So 1 minute. Where will you find initial margin here? What does it say? You're going to be looking at speculative margins, although you're doing a hedging project. 100 initial margin requirements are 100%, 110% of the maintenance margin requirement. Okay, so later on we'll have to find out what the maintenance margin requirement is. Yes, in this example, they have given you that the maintenance margin requirement is this 1400 here, and so the speculative initial margin is 110% of 1400, which is 1540. Yes, so you have to figure out for every contract. 1 minute. For every contract, you have to figure out IM and MM. Okay. So please remember to finish one. Let's see what is left in this futures. Then we finish the future segment. I want to move on to the case, which is your project. 1 minute. Not now. Not now. Not now. All this. 1 minute. It's just 45. Please read all this stuff. Okay. Finish the futures readings. Finish the future readings on your own. All right. Okay. You thought I was going to cover the next topic also now. No. I'm cruel, but I'm not that cruel.
It's fine.
Yes.
Sir, not.
You want to go out again?
No, sir. This is not. I have to ask something, but not from the syllabus.
From where?
Sir, it is about the classes that you are changing. That.
Okay, it's an administrative question.
Yes, sir.
It's not a technical question. Anybody has a technical question? Okay, let's pause.